Welcome to the May Spotlight on Investments, brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Investments is sponsored by Gradient Investments, LLC. Finally, experience on your side. For more information, please visit gradientinvestments.com. U.S. Treasury Secretary Timothy Geithners recently told an official inquiry that a failure to provide regulators with enough legal power, combined with the quick growth of a shadow banking system, led to the recent financial crisis. In testimony before the commission charged with investigating the causes of the crisis, Geithners said that poorly regulated non-bank financial firms had approached the same size of the traditional banking system, with $8 trillion in assets. According to Geithners, the shadow banking system was backed by short-term funds and thin cushions of resources, making it particularly vulnerable to a classic run or banking panic. He also noted that while a broad regulatory overhaul is crucial, preventing banks from engaging in some risk-taking on behalf of their consumers would cause its own problems. Quote, "We cannot make the economy safe by taking functions central to the business of banking, functions necessary to help raise capital for businesses and help businesses hedge risks, and move them outside banks." Unquote. The Federal Reserve is mulling the disclosure of more supervisory information after the success of public disclosure as part of last year's bank stress tests, according to Fed Chairman Ben Bernanke. Last year's stress tests were performed on the 19 largest U.S. financial firms, and the results were then disclosed publicly, leading to concerns that weaker banks might be harmed by disclosure of the results. While some predicted that the public disclosure would backfire, Bernanke said that the test actually helped to diminish uncertainty about bank losses, thus encouraging private capital back into banks. He added that while the scope of last year's stress test was a one-time occurrence, the Fed is currently increasing its use of cross-firm horizontal examinations. Fund managers in the U.S. increased their exposure to equities during April, while decreasing bond allocations due to signs that economic recovery is sustainable, according to a recent Reuters poll. The poll, which surveyed 12 U.S. management firms, found that the companies held an average of 65.2% of assets in equities, up from 64.6% 1 month earlier. Meanwhile, the equities allocation had been 66.2% in February, the highest figure since the financial crisis. Other Reuters U.S. polls this year show participants have maintained a high exposure in U.S. stocks. In addition, with approximately half of S&P 500 companies having reported quarterly results, 82% have beaten analyst expectations, providing further hopes of sustainable recovery. I'm Paul Wilson, and thanks for watching the Spotlight on Investments. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.